The most popular Sunday show on the channel is one and only Mr. Dan Bird, where we look back at the last
Wait,
week.
wait, hey,
Look
wait,
ahead.
wait, wait, wait. Am
Yeah.
I the only show on Sunday?
Oh, I do 6 shows on Sunday, man. What are you
Oh,
talking about?
okay.
Come on, man. I do 6 shows a day.
Just wonder when
Uh,
you say the most popular.
you're just killing. You're just busting my
Like
balls, man. Come on.
it's like when I tell my wife she's my favorite wife.
Don't do that, gentlemen. That's a bad move. That's a bad move. All right, Mr. Dan Bird. Thank you for interrupting my flow. This is why this is live TV. What happened in the market last week? We got a CPI print that came in hot, as you called. Congratulations.
Yes, I did.
Just so you know, I have ordered a Nailed It t-shirt for you. A lot of my audience is like, you need to present Dan with a Nailed It t-shirt. So I did order you one. You will get it at the Vegas event because you've been right a lot.
Okay, well, I still have like 5 or 6 weeks to be wrong. So
Oh,
hopefully
yeah.
hopefully I can still get the shirt.
Yeah, that you want. Well, here's the deal. You've already earned it. You can't unearn it.
Okay. All right.
But you can also earn a Swing and a Miss t-shirt. So you can still earn that one.
That's true. Yeah.
All right. So let's
That is
talk
true.
about
But
the
yeah, CPI went up just like I said. I mean, I explained why I thought that last week. And I thought it
up a
would be
little
at
bit
least
more than you thought.
yeah, a
Didn't
little
it?
more than I thought. I thought it would be at least what they were forecasting, 3.2, which was higher than the previous month. And I thought it had a chance to be a little higher than that even, but it was actually higher than I thought it would be.
Yeah, 3.4.
Yeah.
Yeah, I
And
didn't
based
see
on that,
nobody
we
had
talked
that.
about February. The February CPI might have brought us below 3. I don't think we're going to get below 3 now.
Oh, I mean, that'd be a big move, right? 0.5% a
Right.
month.
Yeah. Yeah. I mean, it will go
You could be
down.
right.
It
Oh,
will go
yeah.
down, but that's a lot. That would be a lot. So I don't think we're going to hit below 3 yet.
Yeah, I think you're right. Did you also see PPI on Friday?
PPI came in lower. Yeah.
It was actually deflationary, not disinflation. It was deflationary.
Yeah. So let's talk about that. Let me bring up a chart because I
Okay.
created a chart around
Ooh,
this topic.
of course you did. Oh, you're the man with the charts.
I have charts for everything.
Yes, you do.
All right. So yeah, PPI did come in a little bit lower. For anybody that's interested in getting my newsletter, you can just go to breakpointtrading.net and click on this button right here.
Mhm.
And it's free. You don't have to sign up for anything. If you want to be notified that it's available, then you should register your email at least, which is down at the bottom of the homepage. But you don't have to. You just want the newsletter right down here. The $0 one just registers your email.
Yep.
So let's first look at a couple of things I want to show, especially related to deflation. So here's PPI. And there's what it looks like. So there's the 12-month window.
Mm-hmm.
And yes, quite a bit lower actually.
Mm-hmm.
And the 3-month rate of change in particular is dropping really fast.
Yeah, look at that. And again, just for folks that don't know, PPI is what you can consider wholesale pricing.
Right.
CPI would be retail. So again, many people look at wholesale as a leading indicator to consumers, just so we have reference.
Yep, that's right. So yeah, right here it's below 0. The 3-month rate of change is below 0.
So that's an annualized.
And the 12-month too, actually.
Yeah. PPI is all variables are pointing to deflation at the wholesale level. Correct. The other thing you got to remember about wholesale, folks, is it is on goods. That's the other thing that was in CPI, because I've actually went back and looked at CPI, the variables that make it up. I spent some time on that on Friday.
Right.
We are seeing, generally speaking, goods inflation deflate. What is rising is services. Now, again, it's not perfect, but if you break down much of the goods, it's deflation. But we are, and oh, by the way, we're an economy that is, I don't know, 60% services versus 40% goods. But that's why we got a surprise CPI pick up.
Yeah, and that's typical. That's usually what happens. Goods will decline or increase first.
Correct. That's very true. Correct.
And services are also stickier. Takes services longer.
Yeah, it's because the largest input is wages, and wages are very sticky. Correct.
Yeah. Yeah. So that's PPI. So let me show you CPI because this is interesting as well. This is a 33-year chart of CPI.
All right.
So
So
the first thing,
what am I really looking at here?
all right. So first thing to notice is everything in green is CPI. So the first thing that you should realize is that inflation keeps going up.
Yeah. I have a saying, inflation's a feature, not a bug. So this is,
Right. Yeah,
yeah.
exactly.
Okay.
So it keeps going up. You know, when we talk about deflation, when inflation is getting better, well, and the rate of change is declining,
Yeah, it's
but it's
disinflation.
still going up.
Correct.
And you can see down, and the red ones here, that's when CPI declined. So that's disinflation.
Okay. Okay.
So all those red bars right there is disinflation.
Got it.
And the one down here shows you the actual inflation rate. And we've got deflation back here in 2009.
Mm-hmm.
And we had a little small period of deflation here in 2015. And then we right now are sitting right at just above the 3% level.
Right. Okay.
But you can see how far back 3% goes.
Mm-hmm. Oh yeah,
So,
it's a trend.
right.
Yep.
So, you know, the Fed wants to be at 2%, but you know, that's probably, they might get to 2. We've been to 2 before, but anywhere between 2 and 3 is pretty normal. And I think the whole economy, everything that we're doing is getting back to normal.
I agree.
What does deflation mean? Is deflation a bad thing? Is it a good thing? Is it, you know, what is it? So we had deflation here for 6 months.
Yeah. I would say, again, I don't know where we're going with this.
Probably 9 months.
Yeah. I would tell you deflation in the long term, saying a year or longer, is horrible for an economy.
Yes.
Deflation in a quarter or 6 months, not really an issue. But yeah, you get a deflation for a year like China's starting to see, you could see the entire economy crumble.
Yeah, and that's because people stop buying things.
Correct.
They think it's going to be cheaper,
tomorrow.
so they don't buy, and if they don't buy, then producers stop producing or slow down producing.
Layoffs increase.
They lay people off. They stop opening factories. They don't hire.
Capital investment goes to zero. It's just all bad. Yep. Right.
Deflation in the short term, though,
it's fine.
We'll stop this line from, in fact, reverse this line, make it come down. And you know, when this line comes down but does not go below 0, that's what these red bars are.
Got it.
That's disinflation.
Got it.
But if this line down here actually goes below 0, that's deflation. That means there's a negative rate of change.
Yeah.
Now, why is inflation a good thing? Because I've had conversations with people that say, why should we even have 2%? Why don't we just have 0? Well, you have to have some inflation. You have to have growth in the economy, because you know that is a healthy economy. Some inflation is actually healthy, but you don't want it to run away like it did here when it went up to 9.2%.
No, that's bad. Yes.
Right.
Okay.
But this is a good chart that shows how we're getting back to normal, basically. The other interesting thing about this, and I was kind of surprised, I didn't know what it would look like, but I overlaid GDP on top of the CPI.
Okay.
And during the periods of growth, so periods, at least except for this 1990 period, but most of these other periods, GDP was outpacing CPI. So GDP was outpacing inflation.
So again, to translate the stuff I talk about on my channel, that is the difference between real and nominal. So you're having real GDP growth anytime the gray is above the color.
Right. That's right. Exactly. Okay. And back in the 90s, which was a raging bull market, the economy was doing great. Inflation was actually higher than GDP.
Yeah. So right. Okay. So you had nominal GDP growth, but not real GDP growth.
Right.
Okay.
Wow, I didn't really know what this chart would look like when I started building it, but I think it's actually pretty informative.
Yeah, I think so. Yeah, just further validates we need to appreciate that inflation's a feature, not a bug.
Right. Right.
And you have to make investment decisions, understanding and appreciating that. Yeah. Okay.
Exactly. So that's CPI. Let's talk about the Santa rally, shall we?
Yeah. I'm going to guess 2 of the 3 are negative.
That is correct.
Yes. I've been following. I've been trying to go, what is the Santa Claus rally? All right.
2 of the 3 are negative. And I actually talked to Jeff at Stock Traders Almanac,
Oh, nice.
and I asked him, because you see up here, there's a little green area.
Mm-hmm.
So I asked him, why do you calculate it from the close of the day before? So the first 5 days right here actually is calculated from the close on 12/29.
Okay.
So why wouldn't you calculate it from the open on the first day of January?
Mm-hmm.
And then, calculate it to the close on the 5th day. And if they had done that, it would have been green. And
Ah,
he said, because that is the standard that is used across the industry. The close of the previous day is pretty much set in stone, whereas
right.
the open is not, because there's a lot of pre-market activity that goes on.
Correct. That makes sense. Okay.
So that's the reason he told me that they do it that way. And because of that, I mean, you can see it's minus 0.13.
Yep.
Barely, it was
Still
basically flat. You could almost call that flat,
okay.
right? But technically, we did get 2 out of the 3 now are negative.
Yeah, and we will get the 3rd until the end of the month.
The end of the month, right? And here is this is from Stock Traders Almanac. This is their analysis.
Mm-hmm.
So the one on the top is when 2 of the 3 are negative, but the 3rd, the whole month of January, is up.
Okay.
This is, and these are the years that happened, including 2024.
Okay.
You can see the average gain for the last 11 months. So February
Wow.
to December is 15%,
Huh.
and the full year gain is almost 20% still.
That's wild. You get 2 negative signals, but
Right.
the 3rd is, again, we're making an assumption. The
Yeah,
3rd is
we're making an
positive.
assumption. Now the one below is if all 3 are negative.
Right.
And
Okay.
that changes the picture dramatically.
Yeah, that goes from a whopping 26 to 1. The
Right.
median. Yeah.
Or if you look at the average over all the years,
Yeah.
it goes from 20% to minus 3.6.
So that 3rd
So
variable is important.
that's a really important one. And in fact, if we look at last year, when all 3 were positive,
Mm-hmm.
the first one was just less than 1%.
Mm-hmm.
The second one was less than 1.5%, but then the full month just zoomed higher.
Right.
So the rest of the month of January is going to be really important.
Okay.
So we'll continue to track this. This is out there on the website for anybody that wants to see it. We are trending higher, which is good.
Mm-hmm.
However, there's something that I'm a little concerned about, and that's on the McClellan oscillator, which calculates the advancers versus decliners.
Uh-oh. That's not good.
You see it?
I do.
Negative divergence.
Yeah, in a pretty significant way.
Yes. So we've had a really nice rally the last week,
Mm-hmm.
but there are fewer and fewer advancers contributing to that rally. There are more decliners because it's below 0 now.
Yeah.
So there are more decliners even as the market has gone higher.
Wow.
So that's not a good thing.
No.
In fact, like I've always said, here's a positive divergence back here. That was the prelude to this big rally starting in November. So I've always said that divergences are one of the few leading indicators. So I always pay attention to those.
So let me ask you this. You don't have to answer, but I'm going to ask anyway. Did you do anything in your portfolio because you spotted this week? Did you sell out of positions? Did you raise stops? Did you do anything?
Yeah, good question. I sold out of everything except NVIDIA.
Okay. So you got flat other than a stock that you plan to hold for a long time.
That's right. And we'll look at that in the next session. We'll look at all the Magnificent Seven real quick in the next session.
So, and again, I want to be clear, right? You're active. You're an active trader.
Yeah.
You do have some long-term investments, aka Nvidia, but you're looking at this stuff every day. It's your website's updated every day. You saw this. What day did you make? What day did you go flat? What day did you sell during the week?
Actually, let's look at the chart, the S&P chart, back on the home page.
Mhm.
So I basically sold on Thursday.
Okay.
When we weren't making much headway right here.
Yep, I see it.
And it's right. It's potentially a double top.
Okay.
Right there. So there are just some signs that we might have some short-term weakness. Now, I don't think it's going to last very long.
Right. But you made a call. You take what you've brought to this channel and you made a personal, not financial advice decision to get out of everything except your one long-term hold.
That's right.
Okay.
Including the this one that I was experimenting with, tracking over here, this Turner Capital thing. But as I think I said last week, I posted that I got out of this one QLD, and some people were confused, and they said, well, I thought this was a long-term strategy. And it is a long-term strategy. So I'm not posting my own personal bias on here anymore.
Right.
I'm just showing what the results of this strategy is so far.
Okay. All right.
Up 85% since March. So 10 months, 85% in 10 months.
Again, that's just using their strategy, not your money. It's just their strategy.
That's right. And I did have my money in it. I did.
Right, but you got out.
But I wasn't following their strategy. So I was following. I got in it on their strategy, but I was using my process instead.
Understood.
So this is a weekly chart. So I got out here on this blue bar. And now it did come back up. So maybe that was a mistake. We'll see. I don't know yet. But
not financial advice. We're just trying to learn how you saw a divergence. The divergence told you there was a problem, and you made a decision based on that. It's all good.
That's right. Yeah, and my whole strategy is to preserve capital, right?
Yeah, you're at a different point in life. You're not
right. Yeah. If I have a gain, then I will move my stop up to halfway between my purchase point and whatever the high was. And if it keeps moving up, then I'll keep moving that up, so I can't lose. In fact, I'm going to make a gain on it.
Right.
But if things reverse, and even if there's a short-term pullback, it's going to take me out with that stop. But it will take me out with a profit.
Yeah. No, I got you. Very cool. Anything else you want to talk about on this? Yeah.
Yeah. One thing that I did on this, and I actually sent this to Mike Turner also, I was curious, using this strategy, what if we had this strategy back during the 4 major bull markets over the last 25 years?
Oh, interesting. Okay.
Could this have told us or got us out sooner? So I put these charts together. I actually put them together for him, and I said, hey, you can use these in your presentation if you want to, but this is the .com crash.
Okay.
So remember now that the strategy is a long-term, using a weekly chart following the crossover of the 40-week moving average, which is, in this case, is this red line, and the 50, I'm sorry, the 40 is the green line, and the 50-week moving average is the red line.
And the other thing I remember about this strategy is it's very limited trading. So if I'm reading this right, you got out October of 2000, and you're not back in until May of
2003. That is correct.
You're in cash that whole time.
So 3.5 years
of cash.
Cash. Either cash, or if you really played their strategy, you would do the inverse.
Oh, you'd be short. That's right.
You do the inverse double leveraged ETF.
Right.
So you would actually make 31%.
Okay, got it. All right,
that's downtrend.
Cool. That's right.
Or you could just go to cash and preserve your capital. But my point, the thing that I was trying to figure out is, would this have told us that we should get out, that something was coming? So far, so there's a .com.
All right, so that's
good. That was a pretty good one. It didn't get you out of the top, and it didn't get you back in at the bottom. But
no strategy will.
That's not what I'm trying to do. Nobody can do that. I want to try to capture 80% of the move in between.
Exactly, 80% of the move. I love that. So I call that a win for the first one.
Yep. And the other thing is this one down here, the green area down here, is actually Turner Capital's That's their chart.
Mm.
That one and the green and red moving average lines up here, that basically is their strategy. That's what they use.
All right.
Now, what I added on top of that, which I actually totally by accident, I didn't even know what this would show me, but this gray one here is something that I've been using anyway that shows me a weekly move. So I just added that because it moves a little faster. And that too, even though there were some little places in through here where it went above the green line, but up here it didn't.
Right.
Right.
Mm-hmm.
But when it went through definitively at the beginning and the end, it was, pretty obvious in both cases. So I call that one a win. So .com crash. The next one is the financial crisis.
Okay.
So this one, it turned red right here. So this would have got you out in January of 2008.
Yeah.
Again, not at the top.
Yeah. But you got 80%.
80%. So was a 30% loss to where the buy signal was. It was like more than 30% to the bottom.
All right. I call that a win too.
Yep. So again, where these crossed again, where it turned from red to green.
Yep.
That was the buy signal. So January of 2008 to basically a year and a half.
All right.
Either be out of the market, in cash right here, out of the market, and then get back in.
All right. I like it so far.
All right. Now the next one is COVID. COVID was very unique. All right. Okay. So I didn't really expect to see the same thing with COVID.
All right.
And here's what COVID looks like. COVID went down so fast.
Yeah.
That this signal was over here. Basically, it gave you the sell signal at the very bottom.
Yeah. I might call that a miss. But again, it was very much a V-shaped recovery. I don't think so many historical models in economics does not account for the COVID nonsense. So it probably is not shocking that this one didn't work.
No, it wasn't shocking to me either. Now, where these moving averages cross down here, remember I overlaid the gray ones? So this would have been my entry to get back in
a little sooner.
The actual signal was over here to get back in.
All right. So COVID once 100 years, hopefully, didn't do well. Okay, makes sense.
Just as an aside, I got out in early February. I got out here on this blue line.
Okay.
Before COVID.
Mm-hmm.
I sold everything. And it had nothing to do with the charts at that point.
Okay.
It had everything to do with the news. And the news, if you remember, the news was just starting to snowball.
Oh, it was
At first they were talking about, a few people got sick and, now 5 people have died somewhere. And then it went to 10 people. And I'm like, this thing is starting to get legs. It's going to grow.
Yeah. All right.
So I'm just going to move to the side and not get run over.
Yeah. You were in preservation mode.
Right. Exactly.
Okay, cool. All right. Well, let's get the fourth one. What was the fourth?
Fourth one is the 2022 cyclical bear market.
Oh, okay. Let's see how it did.
All right. So that's this one.
So
not as much of a downtrend, and it did get you out near the top. Again, it's not at the top.
Yeah.
Near the top. And back in here in beginning of March. Actually, over here in March 31st.
Yeah. All right. So
actually the signal was here, but my process would have got me in on a green bar, not a blue or a red bar. So
got it.
I would have been back in on March 31st. Now, on this particular one, going back to what I did, this is back when we first started talking.
Right.
December 21, right? And I was talking about the negative divergence between growth versus value and the price. The price kept hitting new highs, but growth versus value and discretionary versus staples was showing that the big Wall Street traders were rotating out of aggressive sectors and rotating into defensive sectors.
Got it.
So that was a warning sign. And I actually got out right here in the first week of January because of that.
Nice. Very cool.
So the process seems to work pretty well.
Yeah, not bad.
So, and I'm tracking it, and I track it right here now. Of course, when I first started tracking this, the signal had already been given. We're basically halfway through it probably. So if you catch it right at the beginning, then I think there's a really good opportunity to
Nice.
make some really good returns with only one trade, really.
Yeah, so far.
For a year.
Yes. Well, very cool. One more time, show your network or show your website, and we will do the Magnificent Seven next.
Yep, it's breakpointtrading.net, and you can just click there to get the free newsletter. And there's some little charts here if you want to look at S&P, NASDAQ.
There you go.
Etc.
Check it out, guys. Thank you, buddy. Appreciate you.
All right. Take care.